Hello, I'm Mark Simpson, and this is part 2 of my investing talk on deep value investing, crisis and opportunity. So in part 1, I looked at some of the history of value investing, going from Benjamin Graham through to some modern day value investors. The list of people I was not exhaustive. You don't worry if I've missed one of your favorite value investors off the list. There was a lot out there, but I aim to give a good example of where value investing has come from and where it is today. In part 2 now, I'm going to look at some specific deep value opportunities in the UK stock market. Because I'm going to look at some specific stocks, I just wanted to bring your attention to this disclaimer. So this is entertainment. This is not financial advice. So I'm going to discuss some individual stocks, but this is not a recommendation to trade those securities. I'm just going to share a process that I follow. It's not even a recommendation that you should follow that process. Successful investors take the time to develop their own strategy, and if you can't do that, please take professional financial advice. With that in mind, just remind you of where we finished with the part 1 of this talk. So we looked at that value investing probably isn't dead, despite what some commentators have been saying. But there are some very significant issues with being a value investor in today's market. With the COVID-19 crisis, then earnings are being removed often, even sometimes revenue. So there's a severe hit to those in the short term. And that means that if you invest based on earnings metrics, then it's very hard to be a value investor with those terms. Likewise, dividends and buybacks are being suspended. So if you use things like shareholder yield, you're not able to invest as well as you could before. Broker forecasts and company forecasts are being removed. So again, you can't use forward valued measures to make your investment decisions. I think that a number of compounders, so the kind of classic Buffett stock, are probably still overvalued. We haven't seen yet Warren Buffett deploying much of his big pile of cash, which suggests that those sort of stocks may well be still overvalued. And even using some of the classic Graham techniques of tangible book value, that book value is changing rapidly at the moment. The value of property or industrial machinery is going to be very hard to value in the short term. So where does that leave us? That leaves us, you can see why the market has sold off because of the uncertainty that's out there. But I think there are some good news, and that is that what Benjamin Graham calls a net are back. And a net is formed by taking the cash and cash equivalents on the balance sheet at 100% of their value, adding in 75% of the accounts receivable. So that takes into account that some of the customers might not pay their accounts receivable. So we add a 25% discount to that. We add in the inventories with now a 50% discount. So this is assuming essentially a fire sale price. So if we had to get rid of all our inventory of this company tomorrow, we could conservatively expect to take a 50% haircut on that inventory. And those give us our a very conservative estimate of our most liquid assets on a company balance sheet. And from that, we take off all the liabilities. So not just the, although we've taken the current assets, we don't just take the current liabilities, we take off all the non-current liabilities, including things like pension deficits and anything like that off the top. And that gives us a very, very low valuation for a business. And what we're looking to do is buy that business or buy shares in that business when the price has dropped below this very, very conservative net valuation. And this year, I'm finding that there are a number of nets that are available in the UK stock market. And here I've got a list of some of them as well. Notice I've also included some stocks that are not currently nets, but may be in the future. Ones that are, it's always worth tracking ones that are close to being a net, because any further price falls of the market may take those down to being a net. So I'm going to do a little bit of analysis on these, some of these names, and look at how I would apply the Graham net framework to investing. But first, I want to have a quick look at why net investing works. So it's often called the liquidation value. So the idea originally was if you bought all of the stock in one of these companies, you could sell the inventories at your fire sale price. You could call in all the receivables. You could then pay off all your debts of the company. You could close it down, and then you could return more cash to yourself than you paid for all of the stock. And then if there's any tangible assets as well, property, land, industrial machinery, if you can sell those as well, you get a nice little bonus on top. But there are many reasons why, in reality, buying all the stock, well, I guess the first one is being able to get your hands on all of the stock of a company is probably quite difficult. In the UK, if you own more than 30% or you buy more than 30%, you have to make a mandatory offer for the company. But there's no guarantee that those other shareholders will sell at the net price. So, and even then, when you come to liquidate the company, there could be some costs that are not included or not captured on the balance sheet. You may have severance costs, so having to close a business, you have to treat your employees fairly and meet those severance costs. If you want to release funds in a timely manner, then sometimes you have to take out expensive insurance policies. And finally, although a company may not have a pension deficit on the balance sheet, when it comes to actually having to get an insurance company to buy out that pension deficit, you may end up paying more than the balance sheet valuation. So if you don't want to really liquidate a stock, why would you invest in net? Well, it's because investing in net is usually a sign that those assets that are on the balance sheet are actually unproductive, and you're expecting the power of capitalism to incentivize those management to make those assets more productive. And mean reversion is on your side. I show a chart here from, I think it's originally from Michael Mauboussin, where he tracks what happens to companies that have a very high return on invested capital compared to their weighted average cost of capital over time, and what happens to those companies that have a very low return on invested capital compared to their weighted average cost of capital. What you see is that they mean revert. The highest returns on capital tend to head back towards the mean. However, the lowest returns on capital and those that have negative are actually returning to the mean, and that means that those businesses are becoming more productive, or those assets in those businesses are becoming more productive. So what you see is that although and by definition, the assets in these net nets are unproductive. Otherwise, the market wouldn't be ascribing such a low valuation to the stock. But you can see that the power of mean reversion takes many years. So this is why it's important to make sure you have a certain level of financial strength when investing in net nets. So the company must be financially strong enough to survive long enough for that mean reversion to kick in. But there's good news, because often you're buying companies with very large cash balances. So that means that they have high current and quick ratios. They are generally quite financially secure, which will come as a pleasant surprise in the current times, where companies are sometimes missing significant parts of their revenue and maybe have a negative free cash flow. Then having a very strong balance sheet and a strong cash holdings means that these companies are the sort of ones that will survive this crisis. But it is important to check for, firstly, ongoing cash burn, so how much a business is going to lose in the next couple of years. If they have any off-balance sheet liabilities, then obviously that can can cause a lot of issues, as Enron shareholders found back in the day. And finally, if they have committed capex, so if they can't get out of capex commitments, this might be things like oil companies or mining businesses. And because of that, I tend, when I'm doing my net analysis, is to avoid those sort of small cap miners and oil explorers, because although they have high levels of cash often, or the best managed ones do, they also will have very high ongoing cash burn. They want to invest those cash assets into oil exploration, and they often, the management team will not want to shut the business down, even if early exploration is not successful. So I tend to focus with this strategy on trading businesses and businesses I understand. So the list of businesses I showed earlier, it's not an exhaustive list. It's not a full screen of everything that's in the market. It's selected small cap stocks that I've been tracking and have become Graham net nets, or close to Graham net nets, in the recent past. So first example is a company called Zytronic. So you see here that although it currently isn't a net, so you see that I've taken following the Graham formula, cash and cash equivalents, accounts receivable, inventories, minus all liabilities, and I find that I come up with a net valuation of 15.5 million, of which 13 million is cash on the balance sheet. It's 97 pence per share. Now, although the current price, I think at this point, was about £1.20 when I took this screenshot, this was available, and I actually purchased some of this stock as low as 80 pence in the recent sell-off. I've got to say, I have not all of my stock is bought at that price. I have bought on the way down, but the lowest price I paid was 80 pence per share versus a net valuation of 97 pence per share. And why was I confident that at this price this stock was actually a buy? Well, the first one is the amount of cash that's on the balance sheet. So the company has been returning that cash as dividends over time, but I'm not expecting necessarily the company to pay a dividend in the current climate, but I do think they will be willing to return that cash to shareholders via dividends over time. But how much will that cash be left at after this crisis? Well, for that, I've got a couple of extracts from the 2019 annual report. So you see that the company has, of its assets, it has about 2.4 million of freehold property. And again, I'm not including that in this valuation. And it's got 1.7 million of long leasehold property. And the key point here is there's not going to be significant ongoing rental payments that this business has to make. So even if it paid 10% of its, had a 10% rental charge, it would only be paying 170k per year in leasehold property rental costs. Also, looking at staff wages, because obviously if there's no free cash flow being generated by the business, but it still has to pay wages and salaries, then that cash balance could decrease rapidly. You see here it's about just over 5 million of wages and salaries, so the company potentially could last for over 2 years without any revenue, without becoming insolvent. So I think this is a very strong company and a very strong investment case, certainly when it was a net. Finally, I've graphed the free cash flow. So although I don't expect in the current climate the business to be generating any free cash flow, I think that the fact that this business has generated at least 2 million of free cash flow every year for the last 9 or 10 years, then that means that this is a business that is likely to be cash flow generative again at some point in the future. Oh, and what do they do? You notice that I haven't yet mentioned what this company does, and that's because when you're doing your Graham net analysis, you can be misled sometimes by looking too closely at industry trends, things like that. So what this company does is they make large flat screen touch panels. So they have a business that I roughly understand. They generate they create a real product that sells to consumers, and that, when I'm doing my Graham net analysis, is probably as far as I need to go for in terms of analysing the actual product. I want a trustworthy management, so I obviously want to avoid companies that have very, very poor management, but in this case, my investigations don't throw up any concerns about the quality of management. So I think this is one example that I've been buying recently, and is a good example of a Graham net. Let me give you a second example. So this company is called Xaar, I think is the pronunciation here, and they do industrial print heads. So this is currently a Graham net, although the price, you see the price bottomed about 19 pence earlier this year, and has increased to somewhere in the 30 pence region. It's still a Graham net with 38 pence per share as its net. Again, it has a significant cash balance as part of this net. And here I've given a couple of examples of the sort of things I'm looking for in the recent results. So in the last set of results, which were to the 30th of June, we see that they have they're a loss-making business. So this is obviously one of the reasons that they've been sold so lowly to become a net. But you see that management are taking actions on this. They're expecting to generate £8 million of annualized savings from a closure of part of their business. So here we see the effect of that mean reversion, of management shutting down parts of the business that are unproductive. We also see that not all of their business is unproductive. So in this post-balance sheet event, they show that they have 25 million of cash. So the cash position has improved, and therefore potentially the net position has improved. And that was because they received cash from a partner for an investment into their 3D printing arm. So in this case, they received 12 million for 45% of the business, and they have to invest about sort of 5.6 back into the joint venture. The joint venture also has the option to acquire these shares, and again, I don't think in the current market environment this will happen anytime soon. But I do think this shows that there is some aspects of valuable business underlying this stock, and therefore this is also one stock I currently hold. Although obviously I reserve the right to have bought more, sold, or whatever when you're actually watching this this video. And a reminder that this is not a recommendation for you to trade any of these securities. It's just an example of an analysis that I did and came to a positive conclusion. In contrast, I've got another example here that is a net, was a net, certainly is still a net, but in which I don't hold a position currently. And this is one called Eve Sleep, and they do mattresses and other home furnishings direct to the consumer. So their net value is about 2 pence per share, and I think at the moment they're about 1.4 pence per share on the chart. So that seems a pretty big discount. And you see they're as low as 0.83 pence at some point in the last month or so. But why didn't I take up that offer of buying this stock at less than half its net valuation? Well, here you see some values from its last annual report, or probably actually interim report, and you see that they're claiming they've made a lot of cost savings, which is obviously good and is in the same way that Xaar has made a number of cost savings. However, this business says that they expect to reach break even net of their marketing contribution. Now that sounds a good thing, but when you look at that, that means that potentially the business is breaking even at an operational level, but without meeting its ongoing administration expenses. And here you see we have wages and salaries and other administrative expenses that were about 9.5 million in the last 12 months. So even if that's significantly reduced, then those will be cash costs, and the cash burn of this business could easily be sort of 5 million a year, if not 7 million in the next year, unless there is significant changes to the business. And even though they're an online retailer, the retail environment in the UK is still very difficult at this time. So you see that almost £8 million of cash that was on the balance sheet at the 31st of December could easily be as low as 2 or 3 million in the next year, and therefore that removes the net valuation. In fact, unless they can significantly turn things around, and I see any evidence that they've managed to significantly cut costs, then I wouldn't consider investing into this stock, because the cash burn is too high compared to the net valuation for me. So that's an example where I wouldn't currently invest. Here's an example where I haven't invested, but I'm looking at it carefully. And this is a business called Enteq Upstream, and these do directional drill heads for mainly for shale oil. So you can see why potentially this is a net. This is the outlook for shale oil currently in the US market is very, very negative, and that doesn't stop the net investor. So net investor is often looking for the situations where the outlook is very bleak for a particular industry, because that's the only time you get a stock cheap enough to be a net. So this business reports in US dollars, so I've done a bit of conversion here as well, and you find that you come out with just short of 16 pence per share as the net valuation, and the price from Google at the last trading was 13 pence. So this is at a small discount to the net valuation. But one of the reasons I'm a little bit cautious is that this business has seen cash outflows over the past few years. So it's not like Zytronic, which has been highly cash generative over the last 10 years. This is a business that's still investing for growth and trying to create a profitable business. So you see here the details from the last trading statement. So they said that they had adjusted EBITDA of around $3 million, which is obviously a reasonable value. However, looking at the values I have here for the last 6 months to the 30th of September, you see that net cash from investing activities, so that's the cash they've been investing into fixed assets and things like that, is about 1.4 million. So I would expect on a cash flow basis that this business is at best break even, and in the future, because of the outlook for shale oil in the US, I suspect their business might actually be now cash flow negative. So it will be prudent to take maybe at least $2 million a year off the current cash balance, and that would mean that the business is potentially no longer a net business. There is a bright spot though, and why you might consider this, even though that there is a risk that it stops becoming a net, and that is that it has on its under its non-current assets a rental fleet. So part of its business is actually running a sort of rent to buy process for its customers. So customers who can't fund the purchase themselves, the business uses its personal cash balance to fund that and receives an income stream of the value of those products over, I think it's 3 years. So they have about 2.5 million of rental fleet assets and some property, plant and equipment as well. So I think this business will survive the current downturn, but there is a risk that, for example, some customers won't pay for that rental fleet, and that rental fleet ends up back as a rather than a receivable, it will end up as inventories again, and have to take a bigger write down on those customer debts. So this is a more nuanced one. I think to invest here, you'd have to want to take a view on the current cash burn and get some more information about how this company is coping with the current shale oil issues that we have in the US. Either that, or maybe the price drops much further. If this stock went much lower, then maybe it's a good investment, or I may consider an investment due to the declining price rather than the improving outlook of the market. So hopefully you found those 4 examples useful. You see that of the stocks that I have on here, I've picked 4 of the more interesting ones, and they're you'll find that they're you might say as an outcome that you'll buy at the current price, or the other thing to do with net investing is to set a price below the current price where you would consider buying. The other thing that you might say is that you won't invest at any price. So that might be, or you need more information. So, for example, with Xaar, I think with Xaar and with Zytronic, obviously I was willing to buy those as net investments. With Enteq, I would potentially be a buyer at a lower price. With Eve Sleep, I wouldn't be a buyer unless I see a much bigger turnaround on reducing the cash burn. And several of these other companies, I would again buy at a lower price. One thing to note here is that you'll see that these are very small companies. So actually the biggest company is Xaar at about 23 million pounds. So those of you who are used to investing in stocks of £1 billion plus will not really be able to access these opportunities. You see the very smallest here is actually PHSC with only 1.2 million. And you also want to seriously consider with some of the smaller stocks whether you can get the liquidity to buy, what would happen if you were a forced seller. There's lots of reasons to be cautious with nets, but the fact that the price has dropped and that these are very cheap stocks, or that they face negative headwinds, negative headwinds with their industry outlook, is not necessarily a reason to exclude nets from your investing portfolio. And one of the mottos of the deep value investor, at least, is buy on assets and sell on earnings. So what you'll find with net investing is you buy when the assets, you're getting the assets very, very cheaply, and when hopefully the stock turns around, then the market will re-rate it much higher based on the future projected earnings of the stock, and when you believe the earning stream then is fully valued, you're able to sell the stock and generate a nice profit. Sounds very easy in practice and how I describe it. However, most people won't buy nets. So even with the tools you have and the analysis you can do, to buy nets, you need to be a contrarian. You need to be somebody who's willing to think differently to the market, to go in a different direction. And the reason people don't buy is simple. They're scared by the negative earnings outlook, and they're scared about the overall position of the market. And I think although the the markets have bounced quite strongly back up after the initial drop down. I think there's a lot of fear in the market that the market will drop further, but that's also where you have your list of net or potential net stocks that you're willing to buy when they drop to a low level on a day of market panic. But doing that and actually buying on that day is really, really hard. Going against the market consensus is psychologically hard, and to do that, you need that unique mentality. And I don't think everybody is called to be a deep value investor. Not everybody has that the personality that's required. And if you want to look a little bit further into what that personality might look like, then please check out my book. It goes through the different types of investors and my view on what sort of personality type might be best for those. It's available on Amazon. If you've bought it already and you enjoyed these talks, please do leave me a review on Amazon as well. Subscribe to my channel. Watch some of my other videos. If you want some book recommendations, then just check out my my website, www.xlinkedinvesting.org. And then if you want to chat to me anymore, talk about any interesting nets you're finding, then my email address or Twitter handles are on the screen now. Thanks for joining, and happy investing, everybody.